Hello and welcome to Insurance Business TV for our Environmental Insurance Power Panel. We're going to take a look at environmental reporting under the new Australian Sustainability Reporting Standards that came into force this year, particularly the impact on insurers and brokers and their work. So you can learn more about them. These standards are on the website or digital portal of the Australian Accounting Standards Board. We've assembled our experts. Carla Wilson is Head of Environment and Climate Change at Allianz Australia Insurance, and Anthony Saunders is Partnership Director for EnviroSure at Gal Gates Insurance Australasia. They're both in Sydney. Welcome to you both. To start with, what are a couple of ways these new Australian sustainability reporting standards change the disclosure requirements for insurers regarding climate-related financial risks? Carla, what are your thoughts on that one?
Well, it's the first time that it's been mandated for insurance companies, which is really interesting. It's quite leading globally in regards to how far that the disclosures are required. And so what I mean by that is we're having to disclose what we call Scope 1, 2, and 3 emissions. Scope 3 emissions don't come in till 2026. And just for those people, I am sure lots of people understand what Scope 1, 2, and 3 emissions are, but to give you a bit of a very high-level example for insurance, Scope 1 emissions are like the direct emissions that come from an assessor's car. So if an Allianz assessor goes to a site, the emissions that come directly from their car are what we call Scope 1 emissions. And Scope 2 emissions are the indirect emissions that are from purchased electricity. So all of the buildings that Allianz runs and operates with staff in it, those emissions are what we call Scope 2. So Scope 1 and 2 emissions are actually quite simple and mainstream now for large companies to be recording. The tricky one is what we call Scope 3 emissions. And there's some Scope 3 emissions which we've been collecting for a while, and that's things like air travel and paper. But the primary part of Scope 3 emissions that the regulators are trying to get us to collect is information around our underwriting, our investments, and our claims. So Scope 3 emissions are really tricky to kind of get your head around. But if we are underwriting, let's say, a very large manufacturing facility that has a really large carbon footprint, as the insurer, we are expected to take some of those emissions and report them as part of our own emissions. And same with our investments. So if we invest in high emitting fossil fuel type companies, we're attributed a certain amount of their emissions in our Scope 3 emission calculations. And with claims, it's all around how do our claims providers do their services. So the smash repairers or the building repairers, the emissions that they generate when they do a claim repair for Allianz, we need to take a portion of those emissions. So that's the really big change. And the other piece, which I'll talk about in a minute, but is also around how we're having to disclose about risk management, strategy, governance, metrics, and targets. So it really is not just about data, it's about how that you're running your business and how you're embedding climate change risks and opportunities into your business and your enterprise-wide strategy.
Thanks a lot, Carla. It's quite complicated stuff, Anthony, but I mean, how do you see these scopes and the changed disclosure requirements now?
I think there's two aspects to this, but the first part is that insurance brokers are companies themselves and do have a similar footprint through the Scope 1, 2, and 3, as Carla has described. We then have our relationships with our clients, and those clients do have those same scope analyses to consider in respect to their sustainability. And we have to start thinking about how we're going to address the potential liabilities that those companies may have through those processes, and whether the policies that we have are providing them with the correct protection in the event that they are or may be in breach. So it is quite complicated.
Yeah, sticking with you, Anthony, I mean, what sort of changes will insurance firms need to make in their reporting processes and their data collection to comply with this, do you think?
Well, that's an interesting one. I don't necessarily think that we should be commenting on what the insurance firms should be doing, but look at what we may be expecting of the insurance firms to support us in helping our clients meet their potential liabilities, such as directors and officers' liability insurance policies, providing a cover in the event of addressing meeting and or breaching scope 1, 2, or 3, taking into consideration their environmental externalities. And that's which is an interesting use of the word in reference to the new standard, because environmental externalities is taking into consideration the impact that company is making to the environment indirectly to what they do. That's, for example, let's say that they're a cardboard manufacturing company. They're providing materials for other companies to package their materials. And at the end of the pipe, so to speak, what's going into the rubbish bin is all this packaging. Now, who's responsible for the packaging? The manufacturing company. So the manufacturing company may be faced with a situation where they could be hit with costs associated with the end result of the pollution of the cardboard packaging. We've got the same situation with plastic bag manufacturing. We've got exactly the same situation with car manufacturing, where cars are blowing smoke. What happens when we might all drive around in electric cars, but something's got to be, at the moment, burnt to create enough energy to power the regeneration of the cars. We put solar panels on our roofs. They have a lifetime, and we don't know when. It can be up to, say, 20 years. So we're now facing a situation where the solar panels on many roofs aren't performing anywhere near as they ought to have, and they've got to be replaced. So I don't know that there's any company in Australia at the moment that is really making headway in somehow recycling that material. But what we are seeing, though, is the new generation of businesses out there that are recycling materials, and that creates another risk exposure itself. So for the insurance companies who are looking into these new areas of business, new liabilities, they're going to be relying upon insurance brokers to bring to the attention of the clients the gaps in the insurance company's policies and seek to find ways of redeveloping new insurance policies to cover these new potential liabilities. And if we don't do it, then insurance brokers can find themselves in a situation where they can be sued by their clients for risks or new risks and liabilities that have befalled them that haven't been insured. So I guess there's probably going to be a bit of a race going on out there to try and think about what sort of policies can be recreated or remodified with insurance companies, and get the march these new liabilities going forward, and demonstrate that the insurance industry can begin to educate our general community about how we can meet our Paris Kyoto protocols for the future.
Yeah, I mean, where do you see this changing the way your reporting processes work? And I guess, as Anthony was talking about, your relationship with brokers as well.
So previously, when I talked a bit about scope 1, 2, and 3 emissions, and I mentioned that scope 1 and 2 emissions are kind of bread and butter for companies like Allianz, big companies. We've been collecting that for some time. We call that our own operations emissions. The tricky piece is, of course, this scope 3 emissions. And something to bear in mind that is incredibly kind of mind-blowing is the Partnership for Accounting Financials believe that something like 95% of the total emissions that come from companies like Allianz actually come from our scope 3 emissions. So historically, large companies, we've been focusing on reducing our energy in our buildings, reducing our waste and our water use, all those types of things, which is incredibly important. But what's sort of coming out now is that they're saying that large, banks and financial institutions, something like 95% of our emissions footprint is actually coming from the people we underwrite, the people we invest in, and our claims providers. So what that means is we have to start understanding how we're going to calculate these emissions. Now, there's some methodologies already out there, particularly in the investment and financing space. But in other areas, we're having to kind of wait for guidance and methodologies to come out. But what that means is we're going to have to get better and better and more granular over time, collecting data from our partners, our suppliers, our brokers, and our large customers. So if we're reliant on them to collect this Scope 3 data, the first year we will be probably calculating it using different methodologies that use spend-based data. But over time, what's going to be expected of us is that we'll get more and more granular with the actual emissions data. So we'll be needing to collect that data from our brokers, our partners, our suppliers, and our large customers to understand what their emissions are and what their carbon footprint is, because it will impact on us. And the other, this is getting, quite technical, but it's more I want to flag how the increase in requirements for companies like Allianz with these disclosures. So one of the biggest changes that we're having to undertake is we're now undertaking long-term climate change modeling and scenario analysis on our performance and on our business. And that's basically to inform and look at the resilience of our business model over time. And so there's all this debate at the moment about which scenario do you pick, what time horizons do you pick, and the mandatory disclosures give some guidance, but they don't specify exactly, you need to do short-term, medium, and long-term, but what does that mean? Some people might think short-term is 1 year, some people think it's 5 years. Long-term, from where I come from in the science community, long-term is 100 years, but there's certainly no one in the insurance or financial industry that would be saying long-term is 100 years for them. And with the scenario modeling, you're choosing from all of these different models. You may have heard of them: hothouse world, disorderly transition, orderly transition. So every Group 1 insurer is going to be reporting something slightly different, and that will come out and provide information around the financial impact on the company. But it's going to be hard to compare company against company, because if I choose short-term as 2 years and a competitor or a peer chooses short-term as 10 years, it's got to look quite different with the modeling. The other large thing that's happening in regards to what we're going to need to do with our data collection and reporting is that the data and the information that we collect will be subject to auditing, like other chapters of financial reporting. So limited and reasonable assurance are going to be brought in over time for different parts of the reporting. So it's going to get more and more difficult, and we're going to be required to really, really be able to show why we believe that our information is robust and accurate. So I think probably one of the most important things that we can do is to work really closely with our brokers, our suppliers, our partners, our customers, to help them understand what it is we need to collect and how we can help them if they need support in understanding how they can collect that data.
Sticking with you, Carla, is that then the biggest challenge, just getting this granular data from everybody? Is that the biggest challenge you think you have as an insurer?
I think it will be for 2026. The biggest challenge for us, I would say, this year, we're reporting in March. Allianz reports in March 2026, but it's for the period of 2025. The biggest challenge for us is collecting all of the information at the moment, because we don't have to report on Scope 3 until next year. So Scope 1 and 2, we have, very simply sorted and have for some time. The tricky part for us this first year is pulling all together all the pieces of strategy, risk management, governance, and metrics and targets. And they have to be informed by a really robust climate-related risk and opportunity assessment. So the first thing you do is this climate-related risk and opportunity assessment on your business, and it's across the whole business. So how is climate change going to affect your business? And then you need to be able to prove to the regulator that these opportunities and impacts are being embedded into your business strategy. So instead of always how it's been historically is that you've got like a sustainability report here and the lovely sustainability people do their thing, It's now saying these issues, these climate change risks and opportunities, are no longer a standalone type sustainability issue. They are a business management and value issue.
And Anthony, if it's possible to boil it down, what do you see as your biggest challenge aligning with the standards?
Seriously, we might be selecting, we may be forced to begin to start to select insurance companies that have a focused investment on companies that have the lowest environmental externalities. And we would also be in the position of wanting to only deal with businesses that have the lowest environmental externalities and seeking to provide financial advice to businesses who have a potentially high or very high carbon footprint, who have massive scope 3, perhaps 4 liabilities, and bring those liabilities to their attention, because they've got to start to look at their balance sheet and demonstrate on their tax returns that they are sustainable and viable. And I think this is going to I know this is making a huge change to the way insurance brokers or to the clients out there as they see us. We are licensed financial services intermediaries that are allowing them to maintain their business and help them understand and cover their environmental externalities. And a simple one would be, say, a mining company or a coal seam gas mining company that wants to drill lots of holes, hoping to find one that's going to result in a massive amount of a gas, and they want to maximize on their profits. But are they taking into consideration the costs of mine rehabilitation and those? And I think the impact of this new accounting standard is going to start causing some ripples in the mining industry, and I'm sure you're going to see some advertising in the news from the mining companies saying, that we're such a great contributors to our community for all the services that we provide and the jobs that we produce and the income we produce, but that they're not going to start telling us about what they're doing about the mine rehabilitation. I think that's going to be a huge cost, huge impact. And it's not just the mining companies. So I think for an insurance broker to become more public in respect to their reporting and standards, I think there's going to be a greater level of information to the public about how companies are operating and what companies are we more interested in investing in versus the companies that we don't want to invest in. And from a physical point of view, hopefully we become more granular at home about what we do with our rubbish and how we select what we're buying that may have a lower carbon footprint. It's been like that in Sweden for a long time. I mention that because I know that country provides a level of education from the time the children are born. But Sweden also needs to start thinking about how they're consuming their water. And it's not a never-ending resource, depending upon the sorts of activities that mining companies are carrying out and what's going on in the oceans with ships, etc. I think insurance brokers have a big role to play in how we can possibly influence our clients and provide a greater level of cooperation. I think things are going to really, really change with this, and there's going to be a lot of arguments against. But I've found that Gates is a company that has embraced environmental liabilities as a corporation, and it's a start. And we can work much more closely with insurance companies such as Allianz. Absolutely.
That all sounds very positive, and I enjoyed your Scandinavian anecdote. I'm sure there's a lot we can learn from them. Before I let you guys get back to the serious stuff, Carla, a final question, just in terms of how your communication with policyholders and brokers could be changing under these new regulations. Are these going to change the way you communicate with your policyholders at all, do you think?
Look, I think so, and it might be indirect rather than sending some direct information to policyholders, but it's around how we are communicating our sustainability commitments and the data and information that we are collecting. I think what it means is that we're going to have more consistent and reliable disclosures from companies like Allianz and all of the other insurers. And whilst it might be difficult to compare apples with apples, because as I was saying, some of the standardization is not quite there yet. What you should be able to do is each year look at Allianz's report and go, well, how are they going? How is Allianz tracking, compared to last year, and have they improved in certain areas? I think it will improve reporting across the board. So as I was saying, whether you're Group 1 or not, like Allianz, we're going to be going to our providers, stakeholders, and asking them for data over time. So the level of data and granularity in relation to climate change information will improve definitely over time. And there will be trends that we will start to see over time. And that will start to, of course, create a change and people having different opinions around things that Anthony was saying, and that, talking about, well, can you underwrite a really, really high emitting organization? And I think what's really important here is for us to absolutely and clearly say that the intent is not to abandon anyone. We won't invest in these people. What the intent of all of this regulation and all of this work globally is really for us to work together with our customers and our partners and our brokers and say, how can we work together toward a low carbon future? How can we help you? How can you help us? It's in the best interest of all of us to be working towards reducing our emissions. And as I said, it's not, we have to be really mindful that we need to walk alongside each other. It's not an abandonment, and it's not something that any of us want to see, is that businesses in Australia suffer from this. It's very much going to be a collaborative approach, I think, between businesses to try and move in the right direction.
And Anthony, a final one for you. These standards presumably are already changing your obligations to clients and what information you provide them with. Is that happening already substantially, do you think?
Yeah, yes. We have an environmental liability division specifically for that purpose, where only this month I've come across an insurance broking concept where they only want to be insuring clients that have the lowest possible carbon footprint, and they only want to deal with insurance companies that have the least investment in, or maybe they have the highest investment in renewables. It's starting to change our thinking, and I was just thinking of the potential if we're insuring a company that is a manufacturing, and if there's a high carbon output either through burning of fuels, etc., how do we bring to the attention of a client that there is a potential liability that they've got in respect to polluting the atmosphere that I don't believe that we can insure? We have to try and encourage clients to work diligently to demonstrate that their output is being harnessed in some way, such as with a motor vehicle addressed in 1987 with the catalytic converter. It was considered the greatest end-of-pipe solution of mankind. However, it didn't it didn't change the way that we continue to burn fuel. So there is also a new liability law that's in existence that we don't see here in Australia called ecocide, where companies are being sued at law for causing contamination or destruction to our planet. And there's an emerging liability relating to the directing mind, where I've read in the UK that directors have gone to prison as a result of a worker being killed. And so this directing mind is taking into consideration, is there a consistent flow of knowledge and decision-making process from the CEO right down to the gatekeeper? So I think that the world is changing and our insurance broking industry is changing, that we are now entering an era where we're expected to have a higher level of education that's not yet being addressed through the institutes, but it's something that's going to come within, and they'll be developing educational modules that will come around the fact that the Australian government is demanding us to be more transparent. And these discussions and our developing relations with insurers, it's testimony. It really is.
Well, thank you, Anthony, and thanks, Carla. It's always very interesting talking to you. We seem to touch on topics that we could probably discuss for hours. But that wraps up this Environmental Power Panel. Thanks for watching Insurance Business TV. Bye for now.